Hello, friends. Welcome to our channel. Your financial future is greatly influenced by the state of your credit. You can qualify for loans with low interest rates if your credit is in good standing, which could result in long-term savings of hundreds or even thousands of dollars. On the other hand, having bad credit can make it difficult for you to qualify for credit cards with the greatest benefits and rates, get financing for a car purchase, or acquire the loan you need to buy a house. In this video, we will inform you understanding credit scores by unlocking your financial potential. So watch the video from start to end. So let's begin. It can be challenging to even know where to begin in the credit environment because it can be so complicated and perplexing. Investing in learning the ins and outs of your credit score is the first step to obtaining great financial health. Your ability to unlock your full credit potential and reach your financial objectives will improve as a result of learning about your credit score and the steps you can take to raise it. 1. Understanding the basics. Typically, a credit score falls between 300 to 850, with higher numbers denoting greater creditworthiness. This score is used by lenders to determine the risk of lending to you. Your score is influenced by a number of variables, including your payment history, credit utilization, length of credit history, categories of credit, and most recent credit queries. 2. Credit report. Each credit agency gathers data and information from lenders to create credit reports. Although there are other credit agencies in the U.S. that provide consumer credit reports, the majority of financial institutions and companies primarily use Equifax, Experian, and TransUnion to verify individuals' credit. The information in your credit report can be classified into 3 categories of information. Credit history. The quantity and kind of your open, active, and closed accounts, including credit cards, loans, and mortgages, as well as their age, credit utilization rate, account balances, and payment history, including the frequency and seriousness of late payments. Credit inquiries. Your credit report will show a voluntary or hard inquiry whenever you ask for credit and the lender makes a hard draw of your credit history. This is distinct from soft or involuntary queries, which take place when you check your rate online or when lenders pull your credit record to mail you a pre-approved offer. Only hard inquiries can affect your credit score for up to a year and can be seen on your credit report for up to 2 years. Hard inquiries are only visible to other people. Public records and collections. Information about past due debt from collection agencies, which may also include lawsuits, bankruptcies, foreclosures, and liens. According to the Fair Credit Reporting Act, FCRA, you have the right to ask each of the 3 major national credit reporting agencies, Equifax, Experian, and TransUnion, for a free copy of your credit report once every 12 months. 3. The top factors that impact your credit score. Payment history. Since it demonstrates to creditors if you have a history of consistently making on-time payments, which is a sign that you are likely to repay your debts in the future, your payment history is typically the most significant component in determining your credit score. Because of this, even 1 or 2 late payments can seriously lower your credit score. Missing payments repeatedly can result in a derogatory mark or negative record on your credit report, which also includes liens, bankruptcies, foreclosures, and accounts that are in collections. Your credit score shouldn't be permanently harmed if 30 or 60-day late payments don't occur frequently. However, if you've already missed a payment by more than 90 days, even just once, credit scoring models will assume that you'll probably do it again. Your credit report and your ability to obtain credit or favorable rates may suffer as a result. Credit card utilization. The debt-to-limit ratio, sometimes referred to as credit utilization ratio, calculates how much of your total credit card limit you're actually using. Maintaining a credit utilization ratio under 30% is a good general guideline, but the lower the better. In addition to lowering your credit score, a high credit utilization ratio may cause potential lenders to be concerned that you are already overextended and may not be able to handle more debt. The total balances on all of your cards combined, less the entire credit limit, is your credit card utilization ratio. Age of credit and established credit history. As long as you have a history of consistently making on-time payments on your open accounts, building a long credit history normally raises your credit score. The duration of all of your credit accounts, including the oldest, newest, and average age of all of them. The duration of particular credit accounts and the length of time since you last used each account are all factors that go into this component of your credit score. Credit mix and number of accounts in use. Your credit score is influenced by the kind and quantity of credit accounts you have open, including credit cards, vehicle and student loans, mortgages, and other lines of credit. A higher credit score is generally the result of having more open credit accounts. Why? Having additional accounts indicates that you have received credit approval from more lenders. Hard credit inquiries and new credit. An inquiry is recorded on your credit report each time someone pulls it, such as a lender, landlord, or insurance company. Remember that there are two sorts of credit inquiries, hard and soft, and that only hard inquiries affect your credit score and are accessible to others on your credit report. 4. The importance of monitoring your credit score. Loan approval and interest rates. When deciding whether to approve your loan application and what interest rate to provide, lenders mainly rely on your credit score. Better loan terms and cheaper interest rates can be obtained with a higher credit score, which will ultimately save you a lot of money. Financial opportunities. Financial opportunities are made available by having a high credit score. It can make it simpler to obtain favorable mortgage conditions, qualify for credit cards with generous rewards programs, or even bargain for lower insurance premiums. Employment and housing. Credit scores are a part of the screening process for some companies and landlords. Keeping a high credit score may improve your chances of finding employment or a rental. Credit limits and flexibility. By regularly checking your credit score, you can gain insight into your financial situation and bargain with your current creditors for larger credit limits or better terms. 5 tips to improve your credit score. Pay bills on time. Your credit score is heavily impacted by your payment history. Make sure that all of your loans, credit cards, and bills are paid on time. Monitor credit utilization. To show that you are using credit responsibly, try to maintain your credit utilization percentage around 30%. Regularly check your credit report. Check your credit report for mistakes and anomalies, and file a fast dispute if you find any. Avoid opening multiple accounts. Too many accounts opened in a short period of time can harm your credit score. When requesting additional credit, use caution and strategic planning. That concludes today's video. I sincerely hope you enjoy this video. If so, please subscribe to our channel and click the bell symbol to see more. Enjoy your day and thanks for watching.